this final video on evaluating monetary policy, we're going to focus on developing some general evaluation points. To do this, we're going to try and have a think about some depends on ideas. Can you think of 6 depends on factors that impact on the effectiveness of interest rate changes? Pause the video and see if you can come up with 6. Okay, don't worry if you didn't come up with 6. You can see 6 now shown on your screen. We've got depends upon the size of the change in rates, the level of confidence in the economy, the overall level of economic activity, what's happening with fiscal policy, because as we know, fiscal and monetary policy tend to work hand in hand, in tandem. Okay, the level of economic development. So let's think beyond the UK context here. We might have a question in the future that focuses on a developing economy. And the final point is the credibility of the central bank. Can you write an analytical chain of reasoning for one of these depends on factors? If you can, this will help you to be awarded higher marks for evaluation in exam answers, whether it be a data response question or an essay question. So we're going to actually take you through an analytical chain that's developed from one of the previous points. And we're going to have a look at the point that's entitled depends upon the level of confidence in the economy. What I'd like you to do now is pause the video and read through the analytical chain of reasoning. We'll then have a look at what's good about this chain of reasoning. So to start off with, the effectiveness of cutting interest rates to boost economic growth depends upon the level of confidence. Here we've got a clear opening sentence outlining the key point of the paragraph, so the examiner will certainly know what your key paragraph point relates to. Moving on, for example, if the central bank cuts interest rates, and assuming that those rates are passed on to borrowers by commercial banks and businesses feel confident about future growth and profits, they will be more likely to borrow because they will be more confident about their ability to repay the loan in the future. Now, what's good in this paragraph is it's making reference to assumptions, and assumptions is a good way to build in more evaluation. Moving on, however, if confidence levels are low, then even if rates are cut, businesses may simply choose not to borrow and economic growth will not improve. Here we've got a further point where a clear analytical chain is used even in an evaluation paragraph. So even if we're evaluating, we still need to make our point and develop that analytical chain to follow it through. Our final point in orange, the use of forward guidance in addition to a cut in interest rates, might be one way that central bank could raise business confidence and make the interest rate cut more effective. This suggests how a policy could be made more effective and shows the examiner that you have a wider knowledge and a good contextual understanding about monetary policy. Okay, let's now think about some other key evaluation points you can use in an essay or data response question on monetary policy. First, what type of inflation is being discussed in the question? Is it demand pull or is it cost push? Because it's going to affect whether or not monetary policy is going to work or whether it might be muted in its impact. Secondly, people struggle to change their behaviour when rate changes are small fractions. If rates change from 0.25% to 0.5% or vice versa, will people respond to those changes? Or do the changes need to be bigger in order to enact some sort of change in the wider economy? Will commercial banks pass on the rate change to consumers? They might not. We said earlier that fiscal policy and monetary policy really need to work in tandem. But what happens if fiscal policy is having the opposite effect? It might be contractionary and monetary policy might be expansionary, and therefore it could cancel the effects of expansionary monetary policy out. Any demand management policy, it's important to think about the multiplier. We know that monetary policy is demand management policy, fiscal policy too, another demand management policy. When you're thinking about evaluating the effectiveness of these, always draw upon the size of the multiplier. We also know that there could be strong time lags. It could be 12 to 24 months for rate changes to have their full effect on altering consumer lending, on affecting business confidence. It can take time for those rate changes to have a full effect. It isn't going to happen overnight, and that's something that's really useful to draw upon in data response questions and in essays. Is the central bank independent of the government and able to make non-political decisions? This point's really important when we're thinking about looking at monetary policy beyond the UK. In the second year of your studies in particular, we take central bank independence for granted, but in some countries the central bank and the government are not independent from one another. So therefore the central bank may make decisions that are actually in favour of the government's ideological or political agenda that is to the detriment of the wider economy and just trying to win votes. And finally, some people, especially in developing economies, don't engage with the financial sector. Therefore, changes in monetary policy won't have the desired impact that the textbooks say they should have. Our final evaluation method involves looking at different types of economies. Why might a rise in interest rates have little effect on reducing inflation in a developing economy? Firstly, it might be the case that households have very little spare income after consumption. There's nothing left to save. Secondly, there may be very little trust in financial institutions and banks. People may not want to save their money if they fear not being able to get their deposits back. This is particularly the case in those developing economies that are rife with corruption. Thirdly, poor or low education levels might actually mean that households don't understand the concept of interest and interest rates, or they might not have the numeracy skills to work out the impact of changes on them. They might not understand the wider consequences of changing interest rates, and therefore they might not actually be able to compute the impact of an interest rate change of 5 to 7%, for example. Furthermore, we take it for granted that we can easily access banks. In a developing economy, poor infrastructure might inhibit this. There might actually be very little access to banks. Finally, in some developing economies, they may be more reliant on microfinance or mobile borrowing. In Kenya, M-Pesa is very common, and this system is very unlikely to be influenced by the central bank's interest rate.